Okay. And we are going to jump right in because the way the morning buzz is designed is for you to actually have your cup of coffee, maybe a pen or pencil, put some creamer in it. We're not going to go super in depth into everything. We're basically going to give you the what you need to know. Okay, so I'm going to share 12 things with you today, and you want to listen to see if you think any of them are going to apply to you. And if you think they're going to apply, write them down, send us a question later, we'll answer it. But it truly is, not this hour-long presentation. It's the what you need to know, your morning buzz, and then you can get about your day. So this was originally the 10 must-know changes from Legislative Madness of 2020. Then it became 12 of 2020 and 2021, and I've had to edit out at least 4 because it has been absolutely crazy. What we're not going to do is go through all of the different acts, okay? But I am just going to give you the things that matter, that you're going to want to hear about and mark down. And I think I said in the invite, this 25 minutes will keep you ahead of the curve all year long, hopefully. If you don't follow me on social media, please do. You can scan that to take you straight to my LinkedIn page. I post a video a week and then just a lot of infographics. But Brian and I, we're partners. We are the Kentucky, Tennessee office of Strategic Retirement Partners. We have 20 locations across the nation. We advise on almost 800 retirement plans. It's actually 14 billion in assets now. It grows every day, but this is what we do. We do retirement plans. And then that's our local team, as seen in the Wall Street Journal, CNBC, Forbes, Her Money. We're pretty excited about it. Okay, so morning buzz, jumping right in to the number one thing that you want to be aware of, part-time eligibility. This is in place. This was effective from the Secure Act. And what they said is that if you have part-time employees that have been there for 3 consecutive years and they work at least 500 hours, they are eligible for your retirement plan. Now, the clock on this did not start until January 1st of this year. So doing the math, we have 3 years before this is actually applicable to you. What you want to know now is, do you have the payroll systems in place to accurately track these hours? Because 3 years from now, you don't want to look back and think, how do we figure out who is eligible? The other thing is the eligibility does not require a matching contribution. This just means that part-time employees are now eligible to contribute to the plan themselves. Number 2, state-run retirement plans. This is in the Biden proposal for older Americans. This is a direct quote. Almost all workers without a pension or 401k type plan will have access to an automatic 401k, which provides the opportunity to easily save. Now, lest you think this sounds a little crazy, I will let you know that 10 states already have one of these in place. It may not be as applicable to you if you have a retirement plan, but you could be getting questions from employees. Maybe you're recruiting, maybe people who are leaving that are asking about moving money from a state-run retirement plan to yours and vice versa. The whole idea here is if you're a small business and you don't have a retirement plan, you could be required to follow the same payroll deductions and then remit the money to the state-run plan just like you would if you had your own 401k. Number 3, COVID loans and distributions. This slide is probably not telling you anything new. Most of you on this call are experienced HR. You're aware that the loan and the hardship provisions increased. You're aware that people could take COVID distributions. None of this is new. It's just now we're seeing the fallout from the COVID loans and distributions. So we have a couple of talking points and pieces of advice for you. What you need to know. Every platform handled this differently. Some platforms automatically enrolled or automatically opted into this program for you. And when I use the word platform, I mean like John Hancock, Transamerica, Fidelity, Prudential. Yours probably handled it differently than somebody else's on the call. So the first thing you want to ask yourself is, did we opt into the CARES Act COVID distribution provisions? That's the first thing you want to ask yourself. Then you want to go back and look what distributions and loan suspensions actually took place, okay? Because the loans, existing and new loans taken during last year, you could suspend the payments for 1 year. With technology today, it's completely possible that your participants were going online and doing things online. Maybe it was directly integrated with payroll. You didn't necessarily catch it. For our clients, one of the things we're doing is going back and looking at what actually took place. And then we're going to the platform and we're saying, what is your process for reinstating these loan payments? So just kind of, again, auditing the whole process. Same for furloughed employees. This has been an issue we've seen quite a bit. What did you label? Did you furlough employees? What did you label them? Was it handled correctly? Were they deemed, an active employee, an inactive employee? Were they fully terminated on your census? I would audit all of those, everything that happened with furloughed employees last year. And then here's the big one, okay? If you do find that you had employees take the COVID distribution, we need to educate them on the taxes. The COVID distributions may not have had a penalty, but they are taxable, and they're taxable pro rata over the next 3 years. So basically, you can take that employee's distribution and divide it by 3, and it's going to have to be reported on the tax return. Your employees have the ability to pay that COVID distribution back in 3 years and not report it on their taxes. But this isn't something that they do through payroll. This is something where they would need to make the payback direct to the record keeper or the platform. What we're seeing here is that many of the employees are not even aware of this option. And once they're made aware of it, they either don't understand the tax implications or they don't know how to pay it back. So we definitely want to educate our employees on how to pay back the COVID distributions. Number 4, fiduciary education of participants. We are very sensitive to what it means to be a fiduciary because we are fiduciaries. We are personally liable for all of the advice we give you and your employees. That is not an enviable position. This is not a position you want to be in because you're not necessarily an investment advisor. You are an HR professional or a benefit administrator. So the DOL did release some fiduciary guidance at the end of last year that alleviates a little bit of that burden on you and provides some clarity. What you need to know is that they have specifically deemed these actions by you to not be fiduciary in nature. Model allocations and interactive tools, that's not necessarily the selection of the managed model, but more so maybe the access participants are having online to the tools and the modelers that they use. The biggest one to me is point number 2, the discussing of retirement plan distribution options, because this is a pretty big deal in our industry. If you're sitting down with an employee and you're explaining to them that they can keep the money in the 401k, they can roll it to an IRA, or they can cash out, the Department of Labor has specifically said you are not acting as a fiduciary, right? You're just doing your job as HR. So to me, that was probably the most impactful part of this DOL ruling. ESG comes second. I'm curious if anybody on this call has heard of ESG. It is definitely a buzzword in the industry. ESG stands for environmental, social, and governance. Okay, think of ESG mutual funds, which is basically what they are. It's a type of investing. Think of ESG as a way to vote with your dollars, as a way for you to say, I'm only going to invest in companies that meet a certain standard. So environmental is pretty, clear cut. There's standards for how green they are, their water consumption, that sort of thing. What are they doing to positively impact climate change, in the long run? Social issues often have to do with diversity, inclusion, pay equity. Governance has to do with things like executive pay, accounting, ethics. Are the manager and employees' incentives tied to the long-term performance of the company? That sort of thing. So ESG investing has really taken off in the last few years, particularly in the 401k space, where very large 401ks are saying we want to vote with our dollars and we want to specifically invest in companies that meet stringent standards. I'll say it that way. What the Department of Labor has said is that ESG investing is okay, right? It's not that it's not okay inside of a 401k, but they have reminded us that we as committees need to continue to select funds based on financial measures, risk and return, and the inclusion in a diversified lineup. So what we can't do is let our employees desire to be an ESG investor override the sound financial analysis your consultant, Brian, and I do every time when we review funds and decide what to include or what not to include in a lineup. Encouraged automatic enrollment, encouraged. This is another huge push, not only by the Biden administration, but also by the American Retirement Association and the Institute for Retirement Intelligence, is IRI. I can't remember what it stands for, but this is really important to them. So we all know that we definitely drive successful participant outcomes when they participate in the retirement plan. We also know, hands down, bar none, participation is higher in plans that have automatic enrollment. So here's what you need to know about this. If you are on this call and you do not have a retirement plan, it is possible that by the time you start one, you will be required to have auto enroll. That is something that is in the Biden plan for older Americans. It's something that's it's definitely a push. We talked about the state-run retirement plans, giving people access to a retirement plan if they don't have one. The next phase of that is if you work for an employer and they're going to start a retirement plan, you need to have auto enrollment. Second level, if you do have a plan, you may actually receive tax incentives to add auto enroll. So it's possible if you have a retirement plan and you don't have auto enroll, you might want to look at what tax incentives there are to add it. And it is totally possible that you may receive guidance that employees should be auto enrolled at 6%. A lot of plans have auto enroll at 3%. So it wouldn't surprise me in 2 to 3 years if the vast majority of the plans have auto enroll at least 6%, whether it be through enforcement or tax incentives or whatever you want to call it. I think that that's the way it's going to go. Peps, Meps, and copycats. Another big thing in our industry, here's what you need to know. There is a pooled employer plan and a single employer plan. So if your company has a 401k, it is probably your 401k and you have complete control over it. Historically, if you were associated with another group, so let's pretend you're a rural water district and you're a part of the Kentucky Rural Water Association. Because you're a part of that association, you could have combined forces with the other water companies to join a plan and get favorable pricing, right? More negotiation power. What the legislation did last year is they have opened the door for something that we're calling open MEPs or pooled employer plans is another phrase for it. It's basically where all of these businesses don't have to have an association link in order to combine forces and be a part of one plan. So there are some advantages to that. You can spread out the cost of administration. It could make retirement plans a lower cost for smaller employers. You're kind of banding together and getting group pricing. There are some things that maybe aren't so great about it. So in real life, while the legislators are all using the phrase PEP, pooled employer plan, in real life, we're seeing the creation of a lot of, I'm going to say, copycats. Okay, it's not actually a PEP. We call it PEP Light. Brian's been a part of our committee that's been working on this, or an open PEP where it has a lot of the advantages of group negotiated pricing, but also avoids some of the disadvantages that came with the legislated PEP. Here's what you need to know. This is really relevant to smaller plans. It is probably not as beneficial for larger plans. So if you're a smaller plan, if maybe you are in like the retail industry or the restaurant industry, or you have high turnover, this could be a good fit for you. I would say if you have more questions about this particular thing, Brian is your go-to guy. He knows everything about it. Number 8, moving right along, the financial transaction tax, the FTT. I did a full video on this a couple of weeks ago. The financial transaction tax is a tax on the buying and selling of financial holdings like stocks, bonds, that sort of thing. This is not a tax on the money you earn. It is not. There's already a tax for that. It's called the capital gains tax. This is literally just a transaction tax. You can liken it to a sales tax. you go buy something at the gas station and it has a sales tax associated with it. This has thrown up alarms everywhere. It is definitely supported by the Biden administration. Vice President Kamala Harris herself actually authored a piece of legislation that included this. So it's coming at us from all angles, and I do think it is possible to be there. Here's what you need to know. A mutual fund is a basket of holdings. Inside that basket of holdings are stocks and bonds, and there's a manager buying and selling. If this applies to those trades, then it could have significant impact on the internal expense ratios of the funds in your retirement account. Morningstar predicts that it could increase mutual fund expense ratios by 30%. It will definitely have more of an impact on an actively managed fund than a passively because there's more trading. And it could totally change the retirement landscape if 401k and 403bs are excluded. So let me give you an example. If this tax is implemented, it's going to raise the cost of investing, period. I kind of joke in the video, say goodbye to zero cost trading. It's gone. But there are some people saying that it is possible if they implement this, they will exclude ERISA plans. That's your 401k, 403b, 457, that sort of thing. So now we have an environment where all of us as investors can invest in our workplace plan and not have this tax, or we can have our own IRAs or brokerage accounts and have this tax. If that were to happen, it is highly unlikely that your employees, when they terminate, are going to be rolling their balances out. It's also far more likely that when new employees come into your company, they're going to want to roll their new account into your plan, because the recommendation, of course, is going to be go where there's least amount of taxes, right? If it makes sense. So this is probably one of those that I'm keeping a really strong eye on, because I think it has the potential to be extremely impactful in the whole investing industry. A flat tax deduction. This is actually written into the Biden plan for older Americans. It is fascinating. So when we contribute to a retirement plan right now, we are all used to taking a deduction if you go the traditional route, not the Roth route. Our tax deduction is individual to us and based on our individual income. High income earners theoretically get a larger deduction because they're in a higher tax bracket than lower income earners. What Biden is proposing is that instead of it being just a deduction, based on your own income tax and tax rate, he is recommending that it is just a flat credit. And he has tossed out 25%. So if you save $1,000, you get a $250 tax credit. That's it. So here's what you need to know about this flat tax deduction. And this is specific to the 401k, 403b, that kind of thing. I have a longer presentation where I actually go through the math, but this is what you need to know. It would move us from the personal deduction to a flat tax credit. It would be, depending upon the size of the credit, beneficial to some and detrimental to others. If you run the math and you compare it and you assume a 25% credit, the flex point from benefit to non-beneficial is, someone single, maybe earning 125, 150,000 or above, this would harm them. Everybody below that, it would help them. Married filing jointly, 250,000 in income. So under this scenario, if we assume a 25% credit, it could potentially hurt or harm or be worse for those who earn more than 250,000 as a couple, but help those who earn less. So our concern, even when this first hit the news, and even when I did a video on it, was regardless of how it was communicated, the takeaway was Biden's taken away my tax deduction, right? I'm going to lose my tax deduction in my 401k. And it's complicated. It's not, the average person doesn't understand personal deduction versus credit. They don't understand their own effective tax rate. I am very concerned that if this becomes the headline, that many of our participants are not going to understand it and either discount the value of the 401k or opt out because they think they've lost their tax deduction. When for a lot of them, it could actually be more beneficial, completely dependent upon the size of the credit. So paying close attention to this. Number 10, enhanced tax credits for startups. That's it. I'm not going past that. Most of you on this call have a retirement plan, so it's not relevant to you. If for some reason you don't have a retirement plan, let us know. Now's the time to open it because there are a lot of tax credits to do so. Number 11, tax-free employer contributions to student loans. If you have not thought of a student loan program or a student loan repayment program, you're behind the times. I'm dead serious. Everybody wants to talk to us about student loan repayment programs. It is obviously that where things are going. It's one of the primary reasons why Brian and I have made major career changes, because we saw this as an important benefit and we wanted to be in a place where we could provide a solution for our clients. And 6 months after we make that big career leap, it is written in stone with our government. So they have improved in all of the legislation that you as an employer can contribute $5,250 to your employee student loans, and it is not taxable to the employee. All in an attempt to better align it with a 401k. The whole point is that they want the tax incentives for the student loan repayment programs to be in line with a 401k, because the government feels like our younger employees are being harmed because they have so much student loans, they're not able to save for their own retirement. So they're trying to align the two. What we want to know about student loan repayment programs is they are the wild, wild west. They are not governed by ERISA. It makes our lives incredibly easy. It makes your life a lot easier because you can give anybody or nobody or somebody and not that person. You can decide you just happen to like somebody's personality and give them a student loan repayment program. Not governed by ERISA, at least not yet. So, you know, I joke, if you're not thinking about it, I can promise you that you're the only one. I can also tell you that they are out there, they are running, they are efficient, they are not that expensive to implement. You know, don't be shy. It is the wild, wild west in that you can design whatever program you want to, but they're functioning and moving, right? They're there. If you're interested in one, it can be put in place. Moving right along, sticking on time, pension relief. If you have a pension, all you need to know is that in the American Rescue Plan Act, they did change what you can use as an interest rate and time period for determining your liabilities, which means if you have a pension plan and you're struggling with your liabilities, based on this new calculation, they should go down. That's what that would mean. That just passed like 2 weeks ago. And I have a bonus. This one actually doesn't have to do with retirement plans, but I've been asked a bazillion times, so it's pertinent. So I'm going to share it with you guys today as a little bonus. Child tax credits. This was massive in the American Rescue Plan Act that just came in 2 weeks ago. Okay. First off, they increased the child tax credit to $3,000 per child. It is actually $3,600 per child under the age of 6. This is for the year 2021. Here's the real thing that kind of surprised everybody. In a very socialistic move, I'm not saying it's a good or bad thing. I'm just saying if you can compare it to what other European countries have done, they're actually doing an advanced payment of this credit. So if you have one child and your full credit is $3,000, then starting in July, they are going to send you a $250 check every month from July to December. That's going to get you half of your credit. And then when you file your 2021 taxes next year, you're going to get the rest of your credit. So, you know, it to me, like, I think some parents are honestly just going to be sitting there and getting these checks in July and be like, wow, where did this come from? Especially when you have 2, 3, 4 kids. This is a huge credit. Direct deposit into your bank account, just like a stimulus. And it's going to come. It's a fully refundable credit. I'll say that. So it should help all of the low income earners and all the high income earners. So I put that in there just because people are like, wait, what is this? Also, it is for this year. So everybody's filing their 2020 taxes and they're like, does this affect me? And I'm like, no, this is 2021. So 75,000 an individual, I think, is when it starts to phase out. So it is a lower income limit. than what has previously been passed. Okay, so I think I kept it right at 25 minutes. That was the morning buzz. The 12 things you should know. Hopefully there was something in there that caught your attention. Brian and I, you can LinkedIn message us, you can email us. If there's something in there you're like, okay, she went through this fast and I need to understand more of this, then let us know. But hopefully that was a nice little 25-minute crash course for with your morning coffee. So I just want to say thank you all for coming, and hopefully we'll get to speak with you guys soon.